What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Fred Bell, CEO and Director of Elemental Royalties. Fred, how are you?
Very good, thanks, Jay.
Yeah, thanks for making the time. I'm excited to dive into this story. We always get a ton of interest around royalty plays, and this is not necessarily a newer story. I know you founded in 2016, but maybe it was newer on my radar, to be honest. So I'm excited to bring you on, and I think timing is really good to have a look at this. Before we jump into it, I want to get to know you a little bit, introduce you to my audience. You're a young man, but you know what's interesting is 3 years ago, I know that you won the Young and Rising Star Award at the Minds and Money Conference 2018, probably in London. Is that right?
That's right. I didn't realize it was 3 years ago. It feels, it feels a lot more recent than that.
Time flies, man. Okay, so give us a bit of background, Fred. Who are you and where'd you come from?
So I'm based in London. We started the royalty company privately a couple of years ago, but we listed actually in the summer of 2020 on the TSX-V. So in terms of most investors having any awareness of us, it's probably only the last 7 or 8 months that we would have even been sort of visible. And prior to that, we set Elemental up in 2017, and I think it came through experience of working with junior explorers, developers. And I think if anyone who knows the mining space, will know that the years from maybe 2013 to 2016, 17 were pretty lean years. And they were difficult from a financing perspective. And one of the things that I learned going through that experience early on, and I worked in London for AIM-listed companies, and I was based in Melbourne with one of the other partners here. And I've worked across probably half a dozen African countries and Australia. And I think one of the things I learned is that often with a junior exploration company and developer, it's half the battle is having a good asset. But the other half of the battle is financing it correctly, timing the market, which is very hard to do, and not diluting yourselves. And I think my experience from that was that actually a royalty company, when you sort of take a step back and critically think about the industry, it's a really good way to play the mining sector. And if it's a gold royalty company like Elemental, it's a great way to play the gold space, because what you do is you can actually have exposure to multiple assets across jurisdictions and with different operators, and you can really diversify your risk. And if you can get revenue from different assets early on, you can be as diversified as a mid-tier miner, but you're a $50 million royalty company.
Right.
And that's a sort of light bulb moment when I sort of thought, well, if I'm doing this and I want to set up a company again, I think the way to do it, especially at my age, is to start a royalty company with a difference, which is producing royalties from day one.
Yeah.
That is the Elemental story. We've had producing royalties from the day we started. I think we're the third, in the sort of revenues in the royalty space, really high on the revenue side, and that is, I think, unusual in the junior royalty space. That's, I suppose, a quick background.
Yeah, thanks, Fred. Thanks for that. So, yeah, gold royalty. I think you guys locked up 4 agreements in 2020. Is that right? I want to dive into those. Prior to, though, there's definitely been a surge of new royalty companies listed. And like I said, definitely a lot of interest from my audience. From your perspective, Fred, in your opinion, what's the quick metrics investors should look at when they're valuing a royalty company? Say we're looking at 6. What are some of the quick and dirty rules investors could apply to eliminate half of them?
Okay, so put aside Elemental, just talk royalties generally.
Please.
I'm an investor. I know the space really well now. If I was looking at a royalty company, I think the first thing I'd want to see is the whole reason I'm investing in a royalty company in the first place is because it should be lower risk. It should have diversified revenue as a number one point. Because you have diversified revenue, then you make yourself immune to a lot of the disaster stories of mining that destroy investor returns over the years. And there's a great example in terms of COVID over the last year. And if you are an operator in a jurisdiction through no fault of your own that's been really badly impacted by COVID, you could have your single mine shut down and lose your revenue for X months. But if you're a royalty company and you have 2, 3, 5, 10 royalties with revenue, you might lose one of them, but you've actually got the others. And so you're able to keep going. And so that's my one sort of critical assessment is check the downside risk. Do they have revenue, and do they have revenue from multiple assets? And then number 2, I think, is always quality. And quality can be a number of different things. It's the operator, it's the asset itself, and I think the resource. But if you have good quality operators and good quality assets, you're more likely to have a royalty that will deliver better over the longer term. So first of all, protect your downside. Make sure it's got revenue from multiple assets. Number 2, are these good assets? Are they good quality operators? Are they good? Are they mines that will go not just for 5 years, but 10 years and longer? So I think those are the two key things. And then the third thing after that, and maybe this delivers some of the alpha, is if you've got those 2 building blocks in place, what is the management team and what's her track record and their background? And I always used to invest when I was younger, and I invested in explorers in my early 20s when I knew not nearly as much as I do about the industry now. And actually, one of the questions I hardly ever asked was, who are the management teams and who are the people? But since I've now been mining for the past sort of 12 years, I think one of the first things I'd always ask is, who are the management team, and what have they been involved with, and sort of what track record and reputation do they have? And that is, I think, in the royalty space, that if you get a really good management team with good assets and diversified revenue, I think you're onto a winner. And that would be how I would look at it on a personal level.
Okay, thanks for that. I appreciate that. So let's apply these rules to Elemental. Talk to me about your revenue and how it's diversified.
So I think for us, it was my background. I studied history at university. So one of the first things I did before we set up Elemental was I looked at the history of the royalty space, and the royalty companies, I think, that have often run into issues are the ones that haven't had diversified revenue from the outset. So for us, it's the hardest thing to do. But if you can get some producing royalties on day one, if you can be cash flow positive from day one, your future, your destiny is in your own hands to a much larger extent. And so I think we were really, really selective in what we did. And we bought some royalties from some pretty large operators. So Acacia, who's now part of Barrick, Yamana Gold. We bought one royalty privately. We bought one royalty from, if you know, Carlton Breweries, who are Foster's Beer in Australia. These were big companies that had, in some cases, held these royalties for 20 years. And they were very much non-core assets. And so what we were able to do was we were able to identify the royalty, evaluate them, extract the value, and I think put it into Elemental to give ourselves a really good foundation of diversified producing royalties from day one. And I think that's one of the things that probably set us apart straight away when we came to market to list last year.
Okay. And you're right. It's not easy buying producing assets like this. It's a competitive landscape. So how do you compete, and talk to me about the quality of your assets then, Fred, and how have you been able to be competitive in what's a very crowded space now?
I think if you look at our track record of acquisitions, I think to date, the royalty acquisitions we've done in the last 3 years, I think are second to none in terms of returns. And that's you can see that in our presentations and sort of 2.5 year paybacks on some of them. And I think the way we've been able to do that is that we have, for the large part, we have focused on third party royalties which have not been in competitive processes. And so that's enabled us to, I think, probably turn down 98 in every 100 deals, but focus on the 2 that were really outstanding value. And then when we came to last year, and we did 2 transactions, and they were both our biggest. So a $12.5 million acquisition of a royalty on Endeavour's Wang Yon, and a $55 million portfolio acquisition from South 32. Those 2 deals doubled the size of the company with each acquisition. And what that really did is it gave us this great blend of of value and scale, and both are really important in the royalty space, because you obviously always want the best value you can get to give returns, but you also need scale, because with scale, you get A, lower risk, B, you can have a bigger, more diversified portfolio, but crucially as well, once you start as a listed company, what you really want is, let's just take an example. Your running costs are $2 million a year, plucked out of, just for example's sake. If you have $2 million of royalty revenue, obviously you're covering your costs, but you're still having to raise money to invest on a day-by-day basis. If you then get $1 million of royalty revenue, you've increased your revenue by 50%, but you have $1 million to play with. If you have $2 million additional royalty revenue, you have increased your royalty revenue by 50%, but you've increased your available money to spend each year on investments by 100%. Mm-hmm. So the thing is, because you're a royalty company with fairly fixed costs, each additional dollar that you add in revenue is a really sort of, it can be 2 times or 3 times sort of free cash flow. And that is, I think, where Elemental now is at that inflection point, where we've got more than enough money to pay our costs. And so every $1 million now we add in of revenue is going to be essentially 90% going to the bottom line. And that's really where the model starts to get powerful. And I think that's why we've worked so hard over the past couple of years before we listed to get that portfolio of producing good quality royalties in, so that when we come in now, we can comfortably look ahead and say we're going to have more money last year than this year than we did last year, more money next year than we did this year to invest. And that's a really positive cycle and position to be in.
What are your 2021 revenue projections?
So we announced last year 5.1 million US as our pre-audited but revenue numbers. And then for 2021, depending on the gold price, I think we've said $7 to $7.9 million US. And that's about 4,000 to 4,400 gold equivalent ounces. And I think if you look at the history of the company, we have, since we started in 2017, we have doubled the revenue nearly every year since we started. And so I'd say that those revenue numbers for 2021 are on the basis that we do nothing else. So if COVID locks us down and they cut off the phone lines and brick up our house, then that will still be what Elemental can deliver. And I think that one of the unique things about us is with the South32 acquisition in particular, this year is the first year we have 12 months of royalty revenue from Wang Yon, which was our biggest royalty. And we have our new biggest royalty that starts production in Q2, Australia's newest gold mine. And so next year will be the first year we have a full 12 months of revenue from that. And then in 2023, that will be the first year we have a full 12 months of revenue from Equinox's new acquisition on Mercedes. And so what you get is, you get this, and again, it's one of the benefits with a really scalable royalty model, is that 2021, 2022, and 2023, without doing anything else, we will have more revenue and more royalties paying us each year in the current position we are now.
Okay, now, so we're looking at 7 to 7.9, 2021. What about 2022?
So 2022 is, it includes one of the sort of development assets, but I think what we say is if we don't include that, we're looking at a plus $10 million sort of annualized run rate from the second half of this year onwards. Okay. Once we have Carla Winder in. And then you go into, I think our big development sort of pre-feasibility stage gold project in Western Australia. And one of the things that, again, if you look at the royalty space, and it's a parallel for the mining industry, but we all know that projects often take longer than intended. And mines can take longer to build, projects take longer to come on stream. And one of the things that we did at the beginning to de-risk is we really focused on buying royalties on existing mines. So there was a track record of production. We knew what we were getting. We could see what the royalty had been paying. And if you look at our portfolio, most of them are producing royalties and most of them are up and running. So they're very de-risked in that sense. And I think that, again, is a big differentiator. So that pre-feasibility stage project that we've got, that's probably the big one that's sort of development stage, okay, where the timelines can move. And I think if you look at if you look at a lot of sort of other developers or royalty companies, you'll see that 2021 morphs into 2022, and it takes another 6 months, takes another 9 months. And so if we can have a really good $10 million plus base, that whatever happens, we're pretty confident we're getting that from existing mines, existing operations, then it puts us in a really good place down the line. Even if some of these subsequent royalties are delayed by 3 months or 6 months, it doesn't actually cost us any more, and it doesn't really impact, the amount of revenue that we already have. And I think that's the key position that we wanted to get in, to be in that $10 million plus space.
Okay. Now I want to wrap it up talking about your team. It was the third point that you mentioned when you're looking at criteria. It's usually the first thing I look at when I'm looking at a company. So talk to me about who you've surrounded yourself with, Fred, and do they bring expertise to the royalty business? Talk to me about your executive team. So
it's funny, and it's a funny world, because it's actually two of our directors personally own royalties themselves, and both of those at one stage over operating mines. And so I think we've got a lot of experience, not just in the management team, but actually as well on the board. People who have been personally involved in bringing projects on stream and holding a royalty on it across that period. And I think that if you look at our track record over the last couple of years in what the team has been able to do, I always say it's an awful lot harder to buy a royalty on a producing mine than it is to buy an exploration royalty. And an exploration royalty could probably be a few pieces of paper. But if you want to buy a royalty on an operating mine in a certain country, you'll need to do tax due diligence and structuring. There will be an awful lot more due diligence in terms of legals, tenure, environmental, all of those kinds of things. And so I think for us now, we have acquired royalties over operating mines since we started in Mexico, in Chile, in Australia, in Burkina Faso, and in Kenya. And those are operating mines. And so I think our success rate on deals that we have actually agreed terms on and gone through to execute is we have executed successfully on every single one. And that's something that can often be overlooked. You think, we'll buy a royalty, we agree the price, that's it, done. It's not. And I think we have built up a lot of IP over the years in doing this, and also in the deals we've looked at where we haven't actually bought the royalty, but we have done a lot of work looking at different countries, jurisdictions, different royalties or streaming structures. So I think we've learned a lot both from that and from the people involved. And on our team, we joined Discovery Group when we listed in Canada.
Yeah.
And the principals there, John Robbins and Jim Peterson, I think have a really good track record and network in Canada, and really helpful for us, particularly in the odd year that we've had over the last 12 months, not being able to travel and not being able to come to Canada and America ourselves and market. I think it's really helpful having the benefit of their experience and network with us. And then I think one or two of the other people on the board bring a really good mix of technical experience, which is so important. And if you look at our sort of management team at the moment, the average age is probably in the mid 30s, our sort of day-to-day management team. But then if you look at the people around us, they don't always like me to call them the sort of experienced grey hair, but it's that kind of technical experience that you can't succeed without. We can go out and we can bring in lots of royalty opportunities, and we can do a really good commercial due diligence on it. And we know the marketplace and we know what opportunities work. But I think what you really need is you need people who have been geologists, engineers, geophysicists, who have worked on different mines and seen everything that's gone wrong. And they know the history of the project and they know the history of the people working on it. And you can get a really good feel for that. And so I think we're lucky in that we have some really good quality institutional shareholders and a number of people in the mining space who have been really helpful for us as we've been building the company, and we've been able to lean on some of their knowledge and contact base. And I think that's been really helpful.
Okay. Thanks for sharing that. There's distinct advantages to being part of groups like Discovery Group because of the resources the overhead company brings to the table. We've had Jim Paterson on the show very recently, digging into the Valor story. A big fan of that guy. Okay, thanks so much for coming on, Fred. I appreciate your time. I wanted to introduce this story to my audience and get to know it better myself. So thank you. And I'd love to do this again, maybe 6 months down the road, check in and see how things are going.
Fantastic. Thanks, Jay.